No, it's not. Wells Fargo and Morgan Stanley tie for the number one, number two as my largest. They've had nice runs, right? Bank of America has two, but they're the most leveraged to interest rates and the steeper yield curve, the most of the big six banks. And we know they have a diversified revenue mix. We know wealth management. We know capital markets, investment banking, M&A. By the way, M&A, $5.8 trillion. That was an all-time record for 2021 in M&A for the industry. $47 billion alone in advice from M&A. So all of these companies are going to have phenomenal in M&A in the fourth quarter in earnings reports. Operating leverage, we've talked about this before. They're cutting costs substantially. You're seeing better demand, and they have a very strong capital position, $26 billion in excess capital. They actually have a $25 billion buyback program. They bought $9 billion in the last quarter, trades at 12.8 times earnings, has a 2% yield. I would love to see that yield higher. I think you will throughout the year.
Two other picks familiar to our viewers for certain. WYNN Resorts and IBM. IBM, your biggest tech position. And you think, in terms of WYNN, are you looking to the other side of the pandemic for this one?
Yeah, for sure. I mean, it's down 37% from its highs on the Macau concerns about licenses, terms of licenses, on supervision, those issues. I think that's all in the stock. You have to remember, these guys have size and scale. They have 1,008 rooms in Macau, and they have 739,000 square feet in gaming in Macau. So they have size and scale. They're going to get a license. I don't care if the license term is 10 years or 20 years. Everybody thinks it's 10 years. I'm fine with that. Supervision, we already know that's going to take place. In the meantime, Las Vegas, Boston, seeing very good results, and they have a good liquidity position at $3.9 billion.
Let me ask you about IBM. How much has to go right for IBM this year for it to have the kind of return that you think it can, to be part of something like our stock summit? Of all the, again, I had kind of the same question I asked Jim, of all the stocks in the universe that are out there, and there are other so-called value tech names out there, why this one?
Because I like what the management is doing. They just needed some time to figure it all out. And they are. They are in the process of restructuring, of selling non-core assets, spinning off non-core assets, and buying a ton of companies in cloud, in AI, in quantum compute, right? And even in blockchain, by the way. And so as they sell these assets and they have this M&A, that's going to lead to better growth. That's going to lead to better margins. And you have a mainframe refresh cycle this year. You have an ELA renewal cycle this year. Again, M&A, and they're doing all these partnerships within cloud with the likes of AWS, with Oracle, with Salesforce. They're doing the right things. They're blocking and tackling now that they've made all this M&A, and I think it's going to lead to better growth. And no one likes this stock. No one even knows what they do anymore. And they've got $35 billion in free cash flow, and they've got $4 billion in kind of debt capacity. So they got $40 billion to do more M&A and to be buying back stock and to increasing dividends. And the stock trades at 14 times earnings, and it gives you a 4.8% dividend yield while you wait. Yeah.
Yeah. If it fits into that value tech as your sector pick.
Why the stock looks interesting to me, by the way.
Go ahead,
it looks like it's the stock looks interesting to me technically. It looks like it's snapped that downtrend, but it has not yet broken out. I'm curious why we think all this M&A is going to be good M&A. If you think about all these assets they're selling off, that's all the result of bad M&A. Is it different people making the decisions, or are they making decisions in a different way than they had historically? Because this company's track record at acquiring technologies, frankly, has not led to growth in 12 years.
Right. So it is a new management team. About 18 months ago, they have a new CEO, and he came from IBM, but he was the cloud guy, right? And he was very responsible for buying Red Hat for $34 billion, which I think was a brilliant move. And so he's been behind this whole cloud strategy, getting away from the Kindles of the world, right? The Kyndryls of the world, rather. And so I think that is important, that they're shedding non-core assets. And yeah, you're right. Prior management was not good at M&A. But this new management team, I think they're doing the right things to put them in the right place in the next several years. It's going to take time. We know that. But I do think that this is a very sleepy name. Not a lot of people own it. And as I said, not a lot of people even know what they do or the strategy is anymore. So I think when you have cash flow that's coming in the door like that, 35 bill and 40 bill in total, that's a nice tailwind for them to go and find good assets and not paying above trend.